145. How appropriate, Bill. So
Yeah,
this
no
is
doubt.
perfect. So you are the guy who is going to fill us all in, because as we know, this just changed, but we don't know, there's a lot of ins and outs that are going to be attached
Absolutely.
to what this means for everybody. And as we mentioned, there's been a lot of information that has been given out there, but there's a lot of information that is still, like anything, everything's subject to interpretation. So it's a matter of, let's give some information and also dive more into the tax side that not everybody is aware of, right? Because it sounds good when you hear from the authorities as to what things look like, but what is realistic? What does it look like to set up the corporation, which I know Spencer can attest to, and then when it comes to tax time, Bill can attest to. So let me introduce you to our guests that have joined us. So actually, I'm going to let you introduce yourself. How about we'll start with that, and we'll start with Bill.
Excellent. So thanks for kind of taking the charge on this, Gail, and putting this all together. And I know it's something that, and I'm sure a lot of our guests know, it's been in the pipeline for a while, and this legislation has been pending for a fair amount of time. But it's nice that it's finally here. So my name is Bill Butler. I'm a partner with Death & Company Chartered Professional Accountants out of our downtown Burlington office. So my practice focuses mostly on small and medium-sized private businesses, both on an accounting standpoint and then the tax compliance and tax planning side. So, I've personally been hoping about that this will come through for a while, and now it's here. So hopefully we can give everybody some information on the tax planning side of it and answer some questions along the way. So thanks for having us.
Which is awesome, because it's better to be prepared. It's better to be proactive than reactive, right? Because especially when it comes to tax time and the almighty dollar. So this is awesome. I appreciate you doing this. Perfect. Awesome. Okay. Thanks. And then we have Spencer. So Spencer, I'll let you introduce yourself.
Yeah, I'll echo a lot of what Bill said. Thanks very much, Gail, for setting this up. And Bill and Gail, thank you both for inviting me to attend and be a part of this. I'm really excited about being here. My name's Spencer Cuddy, and I'm a partner at Hunt and Cuddy Law Office in Burlington. And we too work quite a bit with small businesses that are local to the Golden Horseshoe area. And to echo what Bill said, since last fall and probably many years prior to that, I understand RICO's been pushing for some changes to be finally made, and the legislative process can be a very arduous, long process. And despite COVID, I think they've really kept to their timelines, which is quite impressive. So that's very good news for realtors, definitely. And while not the entirety of the act is finished its process and becoming effective, the regulation pertaining to personal real estate corporations has. So that's quite exciting. And I'm also looking forward to learning a lot from Bill. And if anyone has questions, I'll be happy to answer anything relating to the incorporation process and putting that vehicle together that allows you to take advantages of what Bill can offer you.
That's awesome. Thanks so much, guys. This is, especially on a Wednesday in the middle of the day, I appreciate you both being here, and to help our real estate partners and anybody else that is looking to the incorporation. Now, I know we're specific with the realtors, but there is a lot to be said about just incorporating as well, right? Because you don't know what you don't know. So this is wonderful. So thank you. Okay, Bill, I'm going to give you the floor. I'm going to let you, because you are all about, you are the tax man and you know this product. Listen to me.
For sure. Well, I'm not the tax man. He's the guy we're trying to
yeah, that's true.
probably not avoid, but minimize contact with. So it's a very, very, very fine line between tax minimization and tax evasion. So we want to make sure we stay on the right side of that.
Well said.
Can I bug you to share that PowerPoint for me?
Absolutely. Where? There it is.
And you can skip right through the first page, which just is the title and my name. So I think most people remember that now. But as we get into this, so any time, and this isn't specific to Bill 145, but generally speaking, when we sit down to tax plan with clients, there's two main objectives that we look at. So the very first one, obviously, always is tax savings. Any time that we can put a strategy in place that reduces the overall tax outflow, whether it's out of a corporation or an individual's pocket. That's always the first primary goal, is to reduce income tax. And, sometimes when we're not able to reduce tax, or if we're not able to reduce tax as far as we want, then the secondary goal becomes tax deferral, right? With the idea being that you're much better, if you're going to have to pay the same amount of tax no matter what, you're much better to pay that tax 5 or 6 years from now than you are to pay it today, right? Because then you can keep the money in your own pocket for that period of time and get some of that money working for you before you have to pay it to the government. So those are always our two main goals when we sit down to tax plan.
The screen's not
third
sharing.
slide, if
It's not sharing.
excellent. So
I'm so sorry.
okay.
I'm trying to look for the button. My apologies.
And then that's A-okay. No problem at all. So, in terms of some background, they're for a corporation, there are two tax rates really for a corporation in Ontario. So for private businesses, which is specifically what we're talking about here with the personal real estate corporation, the tax rate is about 12.5% on the first $500,000 of corporate income. And then the general rate kicks in beyond $500,000 to tax at about 26.5%. And if we compare and contrast that to an individual, just purely income tax, the lowest marginal tax rate for an individual in Ontario is about 20%. And those marginal rates jump up. And at the top end of that tax rate pool, we're 4 points on every dollar of income we earn. So there's some pretty significant differences between the corporate tax rates and the personal tax rates. And most people at that point say, I'm going to incorporate. Why would I ever want to pay more individual tax? And the reality is that if you incorporate, there are two levels of tax involved, right? So you pay the corporate level first, and then at some point when you extract that income out personally, you're going to pay the individual tax. But I'll dive a little bit deeper into that shortly. Some other things to contemplate: some expenses that we pay in running our businesses are not either I call them disadvantaged. So they're either not deductible for tax purposes at all. So things like club memberships, whether it's, curling, golf, social clubs, things like that a lot of us partake in that generate business for us. Those expenses that we pay aren't deductible for tax purposes. They're always add backs, as well as things like life insurance, and, potentially some vehicle expenses, right? So they haven't updated the cost maximum for what they deem to be like a regular passenger vehicle. And in my whole career anyway, so what they deem a luxury vehicle to be is $30,000. So at some point, I guess you could buy Cadillac's Mercedes for $30,000, but at some point, apparently that's what they tell me.
No kidding.
You'd be hard pressed to go get a Volkswagen Golf today with any level of options in it and not spend $30,000. But we do get some of those tax disadvantaged vehicle expenses. So that's just a little bit of the background of that. So the first question that we get to then is, how can I reduce the tax that I pay? And there's a couple different ways we can do it using corporations. So one of the ways we can do it is to retain the profits at the corporate level during high income years, and then pay that retained profit out in lower income years, right? So lots of businesses go through, cyclical times where, you have some years where you might have $400,000 or $500,000 in profit, and in a subsequent year, you might only have $100,000 or $150,000 in profit. So for a business that's not incorporated, their total tax burden that they are going to pay, and I'll get to some of the detailed numbers shortly, but their tax that they pay ends up significantly more if you have those boom bust years and you're unincorporated. Where in a corporation, you can smooth that out. So that's one way we do it. Another thing is some of those disadvantaged expenses that we've talked about, the golf fees, life insurance premiums, some of the vehicle expenses. If we pay those at the corporate level, although they're not deductible, the corporation is only paying 12.5% income tax if you're below 500,000. And even at the general rate, we're only paying 26.5%. as opposed to having to pay, at a minimum 20%, potentially up to 54% tax on those disadvantaged expenses. And then the third way that we can use corporations, and this has been limited a little bit lately, is to split income to lower income taxpayers in our families, right? So
Right.
what we saw historically probably 3 or 4 years ago, and the tax on split income rules would have been to give, family members, what's referred to right now as non-equity shares. And then, the term that we all got used to hearing about over and over would be to sprinkle dividends out to those shareholders. And that is a much more difficult hurdle to jump today than it might have been 4 or 5 years ago. But there is still some ability to split that income out based on some of the reasonability tests that are out there.
And why is it more difficult today? If you don't, let me just ask you that. Why is it more difficult today compared to 4 or 5 years ago?
Yep. So I guess it was probably about 3 or 4 years ago now. The government introduced a bunch of sweeping tax reform related to tax on split income. So you'll see them referred to as the TOSI rules. So tax on split income. And essentially what they did is they limited the ability to pay dividends to shareholders based on a whole bunch of different tests. So they'll look at things like whether the income in the corporation is derived from services or not. So specifically to our conversation today, this sort of revenue would be deemed to be derived from services. And that makes it difficult to pay anybody other than really the revenue generators or the workers in the business, those sort of dividends, right? So historically, what we might have seen was, a private corporation set up where you had one spouse who predominantly ran the business, and then the second spouse who was a shareholder of some sort that had a secondary job that didn't pay as well. So primary spouse that owned the business might be earning $400,000 in income. Secondary spouse who wasn't active in the business and had another job might only be earning $40,000 in income. So what we would have done historically was split, through using dividends, split a whole bunch of the income from the higher income spouse to the lower income spouse in an effort to use up some of those tax brackets. So that sort of tax planning today gets caught in these tax on split income rules in absence of you being able to pass some of the tests that they put out. And when it gets caught in the tax on split income, you end up paying the top marginal rate of tax anyway. So there's no advantage to it. And oftentimes you'll find it's a disadvantage. So there is some reasonability tests within that. So, it really comes down to, you can do it, right? It's not that you can't pay, other shareholders or family members in the business, but you start to cross into the reasonability test, right? So one way to do it is to avoid paying dividends, is to pay them actual wages out of the corporation. And then you just get into the regular wage reasonableness test. So, it's keeping time records, it's keeping track of what you're actually doing for the business, where before these rules, we didn't have to do any of that. We could just pay it on an account of the shareholdings. So, so getting to our smoothing one here, and unfortunately I don't have the slides put up, but I ran a scenario where, that's okay. It's on my end for the technical difficulties of my laptop, but ran a situation where, we had a taxpayer that earned $350,000 in taxable income in year one, $75,000 in taxable income in year two. And unincorporated, that triggers, it's just under $149,000 in tax in year one, triggers about just over $15,000 in tax in year two. So the total tax paid over the 2 years is $164,000, which is an average tax rate of 38.6%. If that person had been able to incorporate and smoothed their income out and just, rather than drawing $350 and $75, took $212,500 as a salary each year, so they still extract the same amount of money out, the total tax per year is only $70,516. So your total tax paid over the 2 years works out to $151,000 instead of $164. So for that person, the average rate drops to about 35.6 and results in real tax savings of $13,000, right? So that's real tax outflow over those 2 years. And even at that, it creates, and in this case where it's high then low, it creates a deferral mechanism. If it was flipped, if we had a low year and then a high year, you'd end up prepaying the tax a little bit. But again, to save $13,000, it's often worth prepaying it. So that's conceptually how smoothing works. With disadvantaged expenses, I looked at, just $1,000 of disallowed expenses. So whether that's the 50% of meals and entertainment that we can't claim, whether that's golf dues or club dues, in a private corporation that has less than $500,000 in profit, that $1,000 only costs you $1,143 of income. So you would earn, $1,143 in remuneration. You'd pay $143 in income tax. The $1,000 that was left would go to pay that expense, and that's it. You're done. That same self-employed individual, at only $100,000 in taxable income, requires $1,767 to pay that $1,000 of disadvantaged expenses. And at the top marginal tax rate, which kicks in over $220,000, that number jumps all the way up to almost $2,152. So you can see for somebody at the top tax bracket, it's only $1,000 of kind of disadvantaged expenses. It saves you $1,000 right off the hop being incorporated. So there are some tax savings to be had in certain situations, right? And then obviously the second part of this conversation then moves from a tax perspective to deferrals, right? So the other option you have is, if you're not ever going to be able to pay that income out at the lowest rate of tax because you're always going to be in the top tax bracket, then you can use private corporations to at least generate tax deferrals, right? So the example that I ran here was, if you had a taxpayer who earned $200,000 in taxable income every year, but they only required $100,000 of taxable income to support their lifestyle, and all the excess got invested, for somebody who's self-employed, they end up with, when you run all the numbers through, they end up left with about $54,000 to invest. Right? Somebody who incorporates, takes the $100,000 out to support their lifestyle, but allows the corporation to invest the excess on their behalf, they're left with about $87,500 to invest. So that the principal that they have to invest is $30,000 higher. And when you look at that over the course of 5 years, it ends up generating, and I use 10% as a return on investment, but it ends up generating about almost $28,000 extra investment income over 5 years. And the principal balance available to invest at the corporation is $100,000 more at the end of that 5-year period. So you've got a bigger, so although at some point when you extract that money out of the corporation, you will have to pay personal income tax on it, in the accumulation phase, as we're trying to build that volume up, we're able to really kind of get it accelerating. It almost has the ability to act like a second RSP for people who've maxed their RSPs out. So same kind of concept. So, and then just, looking at other considerations, and this isn't purely tax, this is more of a cash flow thing. And you can spend days talking about Canada Pension Plan, because some people have very strong feelings both ways about it. But for somebody who incorporates, you can pay dividends out of your corporation. And because those aren't considered income, they're not pensionable earnings. So you can end up saving yourself about $6,000 a year in cash flow, just moving to dividends instead of paying yourself salary. For some younger, business owners, you get the opportunity to fund your parental leave. So I think we've all, most of the people on the line are probably entrepreneurs. And if anybody's had kids, that when you're self-employed, you're not going to be able to collect, maternity, paternity benefits quite like, a quote unquote regular employee can. So you get the opportunity to build some money up into the corporation and fund your own parental leaves, a little more tax advantage that way.
That's awesome. I never even thought of that. Yeah, that's awesome.
Yeah. So and then down the road too, right? If you're able to build up sufficient assets in a corporation, at a certain point, and Spencer can probably speak to some of this a little bit, but you eventually get to the point that you can start doing some enhanced estate planning using multiple wills. So if you have private corporation wills, you've got the ability to flow some of this stuff out of what non-lawyers still call probate. But you've got the ability to do some enhanced, estate planning with things like that. And then even something as simple as, for people who drive a lot and log a lot of kilometers in a year, If you're
Yes.
incorporated, you have the opportunity to even take a tax-free allowance, right? So sometimes when you run the numbers, taking that, the 53 or 54 cents on the first 5,000 kilometers, and then 48 or 49 after that, that money can be extracted from the corporation on a tax-free basis to the shareholder or the employee, and it's still deductible to the corporation. So sometimes when you run the numbers through, especially as some of these some of the vehicles, like we see more and more uptake in electric cars and things like that, where the upkeep isn't maybe as high, it really is an opportunity for an individual to extract a fair amount of money out of the corporation tax-free and still get the tax benefit at the corporate level. So some other, and most of those, and like most of this, and I probably should have started with this as opposed to finishing with it, but most of these are on a case-by-case basis, right? And what we find more than anything else is, on the surface, what looks like two very similar situations, when you start peeling back the layers, oftentimes, you've got different motivations, you've got different family situations, and each individual situation really requires its own tax plan. And it's not that you necessarily need to reinvent the wheel every time, but you're always kind of picking off the shelf of what's available, and then you want to revisit that, right? Because life changes, right? And what might have been perfect for you today, you might find 3 years from now is totally imperfect for you. So.
Right. Actually, I'm glad you said that, because what about the client that we even just said they're running in excess, so they're keeping more money in the corporation, but let's say business gets quiet. Now they're actually using all of the funds, kind of thing. So what they're making is what they're spending or what they're living on in terms of building the business, right? So is it beneficial to open a corporation? Let's say if you were starting like that, where you didn't have the excess, does it make sense?
So the obviously the deferral mechanism is the biggest part, and everything else being equal, if you pass all the income out of the corporation to the taxpayer, it doesn't tend to create huge advantages. And again, what you would then want to look at is some of the secondary stuff, and everybody in my office has probably heard me say this 1,000 times, but private corporation tax planning really has become death by 1,000 cuts. We pick up the newspaper, and there's one right now that's in the Star about some guy who managed to finagle his way out of $10 to $15 million of income tax to the government, and those are one-offs, and there's ways to do it, but for you to do that, it probably costs you $3 or $4 million in professional fees, and those fees are the same whether you're trying to get out of $100,000 in tax or $100 million in tax. So unfortunately for the average person, those sort of planning techniques just are unattainable. So you really get into the situation of you try and get $500 here, you might get $800 there, and your hope is that maybe by the end of the year you end up $3,000 or $4,000, $5,000 ahead of the game compared to what you might have been otherwise, right? So you're not ever gonna get rich fast doing some of these things, but at the end of the day, if you spend, if it costs you $2,500 to save, $5,000 or $6,000, then it that's probably something you want to look at and consider, right? And at the very least, you want the information available so that you can make an educated decision. Which I find a lot of the time is tough for people. A lot of the time, people can't get their hands on the info that they need. So.
Yeah, because you don't know what you don't know, and you don't know the questions to ask, or maybe you're not working with the right professional, right? Like it literally is what that comes down to. And then some people think that they can open a corporation online, like by themselves without finding any information. But again, you don't know what you don't know, and that's where I would go to like Spencer kind of thing. So if I was a realtor and wanted to open the corporation, so I would come to you. Would I go to the accountant, or would I go to the lawyer, or do I go to both? What's the norm, or is there a norm?
So I'll answer a little bit of that quick, and then I'll pass over to Spencer. I always tell people you want to do both, right?
Okay, perfect.
So that there's part of it. So often what we see in our practice is, people go where the relationship is. So if they've got a really good relationship with the lawyer, they start there and then find the accountant. And if they've got a good relationship with the accountant, they start the accountant and find the lawyer. But there are pitfalls on both sides of it, right? So you want to make sure, if you're bringing in multiple shareholders, you want to make sure you've got the right share classes set up, and you want to make sure you get everybody into the share class that you want. You want, that there's a legal aspect of it too, but for a tax planning aspect, you want to make sure that the shares you're giving people have the attributes you want. So I always say, start where you're comfortable and let that lead the direction. So Spencer, did I miss anything?
Well, I think you're being maybe a little bit too generous towards lawyers. I think that if you are comfortable with your lawyer, that is a good place to start. And I think sometimes lawyers are a tad too trigger happy just to put the vehicle in place because, well, it's a reasonable fee, right? And so sometimes lawyers could be trigger happy to incorporate for a person, but shouldn't really be the person giving the tax advice, in my opinion.
Right.
So if somebody comes to me for any kind of incorporation, I would always tell them that we'd be happy to work with them. This is the kind of information that we need. These are the costs for setting it up, the vehicle. These are the maintenance costs. This is what you have to expect. But before we go down that road any further, I think you ought to get a comprehensive opinion from an accountant to make sure that this actually does make sense for you. Because sure, I can put a corporation in place for anybody, but whether that actually makes sense is something that I think is an opinion much better given by an accountant. And I would say this to anybody too. For a lawyer to give a tax opinion, I think if any lawyer is giving a tax opinion who isn't only a tax lawyer or an accountant, that's irresponsible. The Tax Act changes so often and is so comprehensive. There should be no such person as a lawyer who practices in tax and other areas. So if you have a tax lawyer, fine, but otherwise it should be right. And then we'd be, thrilled to work with anyone who wants to put that vehicle in place, which includes drafting articles of incorporation, producing a minute book that has bylaws in it, and sometimes restrictions on the use of the corporation. And the minute book is really an important piece here. So, Gail, you talked about this. Can a person just go online and file their own incorporation with Ministry of Government and Consumer Services? The short answer to that is yes. But in order for your corporation to be valid after year one, you have to be compliant with the OBCA, the Ontario Business Corporations Act, which realtors are going to have to be compliant with. You need a minute book and you need yearly updates and maintenance of that minute book. Okay, so what some people do is they do incorporate and they do a great job of it, but then by year two, technically they are not satisfying the requirements of the Ontario Business Corporations Act. So there's a little bit more to that. So hopefully
absolutely. So would that be an annual meeting with your lawyer? Like for the minutes? Like
the way that I again typically see this happen is there is an upfront expenditure to set up your corporation, and people are probably wondering what that is, and I'm sure it varies across many different law offices. What we do for a professional corporation is, it does depend on certain complexities, but for most people, it's relatively basic. And the fee for that is just under $2,000, just an upfront cost. And maybe Bill can shed some light on whether those costs are deductible as well.
I was going to say, I bet you they're deductible for business.
Yeah. And then on top of that, annual maintenance is like peanuts, right? So if annual maintenance includes putting documentation in your minute book to be like a direction essentially to pay dividends, that Bill would direct. He would say, okay, based on what happened this year, you're going to pay dividends out in this fashion. Well, okay, great. Thanks, Bill. We're going to draft the documents. We're going to paper that trail. And now your business is still valid under the OBCA. The cost for us as lawyers, we're not doing the tax planning. We're not looking at all of the logistics of your business. So for us, it's very little work, and that's about $250 a year only.
Yeah.
Oh, that's not bad. Wow. Yeah. Okay.
So in terms of legal fees, not that high, I think. Yeah.
Yeah.
No, I completely agree. But And like we're saying, because as things change all the time too, right? That way you're all up to date.
Right.
Awesome. Now, so would can the accountant do the minutes as well, or is that just generally through the lawyer, or who would do the minutes?
So usually what we'll do is we'll send kind of to what Spencer is saying. So part of our year-end process,
Awesome.
we'll prepare a legal letter. So, and in that it'll detail all the stuff that Spencer is looking for that, right? So the date the financial statements were approved, who approved the statements, are dividends issued, were there any bonuses declared? All that information goes into our legal letter, and the client has one for their records and a second copy to send to the lawyer. And then, oftentimes it's just a matter of dropping that letter off the legal office, right?
Right. Okay, that's awesome. I didn't know that. So look at that. Learned something new again today.
Absolutely.
Perfect. Okay, so if anyone has any questions as well, I think we actually covered quite a bit of info, which I think is awesome in a short amount of time. You did well, Bill. So we got, so I think that was a lot covered. So if somebody is looking to say, because now that it's passed, they could actually open a corporation today. Is that right?
Correct. Yeah. So
Yep.
As I was saying, the new act, Trust and Real Estate Services Act, has not been passed, has not been put in full force and effect by the Lieutenant Governor. But the semantics of it is this one section of these changes was passed through an Ontario regulation. So this one section is that you can set up a personal real estate corporation effective as of October 1st.
Amazing. That's amazing.
Yeah, if you wanted to get started today and have it open next week, you could do that. Yeah.
Perfect, because it is that quick for you to do, as long as it's not the end of the month, right? For real estate. So.
Yeah. So as Gail's alluding to, our practice also does real estate, but
right.
Yeah, for corporate services, I would say a 5 to 10 day turnaround time is doable.
Oh, that's good to know, actually. Okay, fantastic. So the nice part about what we're doing today as well is that we're recording this, so that way we can share this to colleagues, we can share it to realtors, we can share it on social media, and that way, and I'm also uploading it to YouTube. That way it's there for as a reference tool. And the other thing we'll do is, I know I've included names and addresses, but then we'll do that as well. But let's kind of do that one more time. So if somebody, Spencer, wants to get a hold of you and inquiring about opening up a corporation, whether it's for themselves as a realtor or whether it's somebody they know that just wants a corporation in general, doesn't know where to start, how are they going to get a hold of you?
So for me, Spencer Cuddy at huntlegal.ca. So my email is best for sure. Our office, you can Google, it's Hunt Legal Professional Corporation. All of our information is on that website. Phone number is 905-634-5581. But email, call, Google, you name it, we're available. So
that's awesome. Great. Thanks, Spencer. And how are we getting a hold of you, Bill?
Awesome. So, as I kind of mentioned off the bat, we're at 460 Brand Street is our physical location. Email is bbutler, so bbutler at deethco.com. Direct line into the office is 905-333-1775. If you're sharing up on social media, I actually, funny enough, I respond to tons of Facebook message inquiries. So,
me too.
Yeah. And I laugh. I get a lot of kind of initial inquiries from people like, well, how much does this cost me? And, I tell people like, I'm not, I don't think I get described by a lot of people as not what you expect in an accountant, and that's good for some people. Some people don't like it. I'm not everybody's cup of tea, and I get that. But I'm open to, to have a 30-minute conversation with anybody and answer some questions. And, to what Spencer alluded to, you'll see a lot of people who incorporate, and not just in this world, but in business in general. You get a lot of people incorporate that probably shouldn't have in the first place if they gotten, and oftentimes it's not even that they got advice. They went on Google and decided that incorporation was the way to go and set up their own. And once you're there, it's not easy to unincorporate and go back. I always tell people it's a lot easier to make your life more complicated than it is less in business. But you know, there are mechanisms to turn sole proprietorships into corporations pretty easily. There aren't really any easy corporate to sole proprietor mechanisms, but
Right.
I'm happy to have conversations with people, right? Like I don't, changing your, like, you know, if you've already got an existing relationship with an accountant, changing accountants is not fun. It's like changing banks and any of those things. It's time consuming and it's a pain. So I don't, the last thing I want is people to sign up here and come in the door and a year or two later go, wow, this guy's not all what I thought he was. And it's just,
Right.
it's a pain, right? So I'm happy to, you know, to a whole bunch of people when I started out took free time and gave it to me. And in situations where, you know, they probably knew that they were never going to get $1 out of me. And they did it because that was just what they do. And I'm very much like that. So, you know, for anybody who wants to have a conversation and, you know, kind of, you know, whether it's me directing them into what sort of questions they should be asking or what sort of things they should be reading, my phone is always available for, you know, 15, 20, 30-minute calls to make sure people don't get down a path they don't want to be down.
And you and I have had many of those conversations, so I appreciate that. And as with Spencer as well, so I appreciate both of you, kind of thing, because that's.
I would echo the same thing, just quickly, that if anyone had conversations, questions, quick phone calls, I'm not a bill by the hour type lawyer, so I'm not sending you a 6-minute bill afterwards. So
Good news. All send the bills normally.
That's right.
So, I'm just.
Everybody
Well,
always says
that
it's
is-
the mortgage broker scale. Everybody always
It's
says it's the
always
mortgage
me.
broker.
It's always me. Exactly. But I call both of you, you know, whenever I'm looking for some guidance or some help. So I appreciate it. So I know my clients do as well. So thank you. This was awesome. I appreciate you guys taking the time out of your day to help educate us on some of the big changes, which we know was a long time in the making. So I appreciate that. Thank you.
Thanks for having me.
And if anyone has any questions, they know where to find you.
Awesome. Thanks a lot, Gail.
Awesome.
Thanks,
All righty. My pleasure. Thanks, guys. Enjoy the rest of your day.
You too. Take care.
All righty. Okay. Bye.